I wanna be there when the people start to turn it around, when they triumph over poverty. I wanna be there when the people win the battle against AIDS. I wanna lend a hand. I wanna be there for the alcoholic. I wanna be there for the drug addict. I wanna be there for the victims of violence and abuse. I wanna lend a hand. Send me to Mamina, to Mamina, Ezizwe, Izoya, Itanaze, to Mamina, to Mamina, Ezizwe, Izoya, Itanaze. Against AIDS, I wanna lend a hand. I wanna be there for the victims of violence and abuse. I wanna lend a hand. Send me to Mamina, to Mamina, Ezizwe, Izoya, Itanaze, to Mamina, to Mamina, Ezizwe.
Thank you so much for the music today, Mpendulu, and good morning, all the beautiful people, all the delegates, everybody that join us today for this very important conversation that we're going to have. And I see that we really have an esteemed panel today that's going to help us. It's a fantastic day in Johannesburg. It's sweltering, but I must tell you, everything is wonderful and green. Colleagues, today we're going to talk about private equity and the value that it adds to your portfolio in terms of diversification. And I see, you know, in the title of this topic, it says, a look at the remarkable rise of private equity allocations globally and what lessons could be relevant for South Africa. But we also have a team, and Ria Papier from Old Mutual Alternative Investments will introduce a panel. And you will see that today we have the benefit of a global manager, we have the benefit of our local service providers, and the executive chairman of Consolidated Retirement Funds, so Isile Mukweni, that's going to share his perspective on this very important topic. So I don't want to waste too much time. I really want to get into this conversation. And at the end, we will allow for question and answer. So at the bottom of your screen, there's a Q&A little button and a chat box. So please, if you have any comments, questions, anything that you just want to note, please do so and we will deal with that. So Ria and all the panel members, you are so welcome. We are looking forward to a very engaging session. Ria and I now yield control to you. Thank you so much.
Thank you so much, Anna-Marie. Good morning and welcome to the principal officers, trustees, consultants that have joined us this morning, as well as members of the broader pension fund and financial services industries. It is my absolute pleasure to be moderating this discussion this morning on a topic that I'm very passionate about, and that is private equity. Not only will we be talking about the role that the asset class can play in your portfolios, but just in South Africa as in our country as a whole. So we're going to be hearing the perspectives of local and international investors who've embraced this asset class. And rather than focus on the theory of private equity investing, we're going to be talking about the how and the what this asset class has meant in their portfolios. We're also going to be addressing some of the challenges that have been typically raised by pension fund managers when it comes to considering this asset class, especially for the first time. Like Anne-Marie said, my name is Ria Papier. I am the Client Director of Old Mutual Private Equity, part of Old Mutual Alternative Investments. Old Mutual Private Equity is one of the largest and most established private equity managers in South Africa. We've invested over 12 billion Rand in the last 21 years. Our focus is on mid-tier growth partnerships. So we look for companies that can grow even in a muted growth environment. Now, if you were at the Bitseta Winter Conference or a recent webinar, you may have heard from my Old Mutual Alternatives colleagues, specifically the infrastructure colleagues and my impact colleagues. I just want to be clear that today's discussion is about traditional private equity, distinguished from infrastructure, distinguished from impact investing. We're talking about the mobilization of capital into unlisted companies in South Africa. So I recognize that trustees today have a significant responsibility to allocate the funds of their members in a responsible way. And I can only imagine that that responsibility is even more pronounced in an environment like this, where traditional asset classes are coming under pressure. So I do think this is a timely topic. And with that being said, I'm very pleased to welcome the panel this morning. We've got 55 years of collective experience. Relevant collective experience. So we've got Soisile Mokweni. He is the Executive Chairman of Consolidated Retirement Funds and one of the largest pension funds in South Africa. We have Svenja Becker, who's the co-founder and managing partner of Moravia Capital Investments, an international private equity fund of funds business, and Lebo Tubisi, who's the head of manager research at Alex Forbes. And Alex Forbes is obviously a key influencer in asset allocation decisions in South Africa. Lebo is also a non-exec director of the SAFCA board. So let's get right into it, I think. We're encouraged by the proposed amendments in Regulation 28 of the Pension Funds Act to increase the limit for private equity investing from 10% to 15%, and also decoupling it from hedge funds. So it's a standalone 15% limit. However, in stark contrast to the 15% limit, the percentage of assets under management invested in the private equity asset class in this country is less than 2% anecdotally. So Lebo, this question is for you. Obviously, Alex Forbes has been a long-time leader in alts allocations in this country. What are you particularly seeing as an opportunity in the asset class that you think others should be considering?
Good morning, Ria, to my panelists and everybody who's online. And yeah, thanks very much for the opportunity. And so I think, it's a very good question. And I think we're fortunate as an organization to have the benefits of broad, local, Pan-African and global sort of view in terms of our relationship with Mercer and what we're doing in the continent from a private equity perspective. And so I think it's important to, when you want to answer about what the opportunities are, is to look at the history, to look at what environments are conducive for private equity. And I would say, in the current environment, it's important to consider the fact that, GDP is a very important kind of determinant. And I think if you look at much of the forecasts and any conversation around GDP in the current environment, is that it's definitely better than sort of pre-COVID levels. And so I think that's a positive element. Another element to look at is how competitive the environment is in terms of dry powder. Capital has been committed. And if I look at the prior vintage relative to now, that I think there are definitely fewer players in the market, which is actually a good thing, for the pricing of underlying investments and the likes. Business confidence is a very important one. I think we come from an environment where business confidence was very low. The kind of numbers that we're seeing in this regards have definitely improved. And so I think from a broad, overarching perspective, I think the environment is better. You speak to many players of the market in terms of what their perceptions are around valuations, whether you're speaking to a player that is looking at listed equity or unlisted equity. I think there's a generalized view that this is a good time to invest given the current valuations. And importantly, as an allocator, it's also a very opportune time, because I think we've seen for at least the last 3 years, in fact, there's been more than 40 strategies coming to market. And so call it a biased market, if you will, from that perspective. And there's certain advantages that come to being able to be in this biased market, is that you can co-create the outcomes. You can co-create what you're looking for as an investor in this space. And importantly, beyond just financial outcomes, I think you can also co-create impact outcomes. I think, it's important to consider the kind of socioeconomic needs in the country. And I believe that private equity, is a strong candidate to assist in this regard. And so I think these are some of the things that we see as advantageous to consider private equity in this environment, Ria.
Thank you, Lebo. Those are all excellent points. Now, just to kind of look at the global or developed market story, Svenja, there's been a remarkable rise of private equity allocations globally over the last 3 decades. My understanding is that the percentage of assets under management just in private equity alone are around 14% globally in developed markets. It would be so useful to hear your insights, Svenja, on the journey that you've seen in the developed markets to where you are today, and why you think the asset class is so popular.
Hello, good morning, everyone, from my side as well. And thanks for giving me the opportunity to speak on such an important topic, and also to take you on a little journey into the past. So when we talk about why is the asset class so popular, I would like to take you back to the 1970s, when actually the first pension funds started in the US and Canada started to look into more non-traditional assets. This was actually in the late 70s. This was actually an era of high inflation and mediocre performance for most listed equity markets. And pension funds realized, in order to fulfill their fiduciary obligations of creating long-term successful portfolios, they needed to migrate into other non-traditional asset classes. And this trend that we had seen in the 1970s in the United States carried on to Europe. A little bit later, beginning of the 80s, first pension funds started to look into alternatives, into private equity investment. They saw first outcomes and successes from the asset class. So they considered starting to invest into the asset class. It was a bumpy journey, so it was not an easy ride. Many of the pension funds who started to invest globally paid some tuition. Nevertheless, looking at where they stand today, it was the right time to start in an asset class that has a long-term perspective. And looking at the outperformance that private equity has created in these pension fund portfolios, it has been worthwhile. And then we saw another increased trend towards allocating in alternatives and private equity, in particular in the 2009-2010 era, with the global financial markets, where a lot of pension funds were negatively impacted and were pursuing a quest for yield. I actually looked up some of the most recent studies and numbers, and the Center for Retirement Research stated that between 2002 and 2016, the share of US pension plan assets invested across alternatives, this also includes infrastructure, real assets, rose from 9% to an astonishingly 26%. And the annual OECD survey of large pension funds revealed that an average illiquid asset allocation is at 15% across 34 countries. So this is really impressive. But why is it? What were the drivers? So I already talked about a few of the drivers, one being diversification. But where the diversification coming from? This obviously stemming from a partial decorrelation to listed securities. And there was a clear expectation for superior risk-adjusted returns, which has delivered. I mean, if you look at the public market comparables and compare private equity to listed equities and also other asset classes, bonds, for example, there is a clear outperformance over long periods of time. So the asset class has delivered. It has brought the level of diversification to the portfolios and made these portfolios more stress resistant.
Thank you, Svenja. I mean, we could argue that in South Africa, we're at the very start, actually, of that journey. So it's just interesting to see how that's progressed offshore. If we just bring that back home to South Africa now, so we see there, you know, with 38 billion Rand of assets under management, 20% of that allocated to alternatives, of which 5% is actually in private equity. Consolidated Retirement Fund is certainly a leader in allocation in the country and an ambassador for the asset class. It would be very insightful, I'm sure, for all of us to hear just your journey at Sierra Fund. Why did you decide to enter the asset class in the first place, and what has it meant for your fund?
Thank you, Ria. Good morning to my fellow panelists and to the audience at large. A very interesting subject to address. Let me just say, Ria, investing in alternatives is not an easy decision. It was not easy for CRF then, and I'm sure it's not easy for any trustee in South Africa. Why? Because it is a foreign concept to many boards of trustees in South Africa. And most asset consultants are not comfortable with this asset class because you need much more work to be done on it, especially in terms of due diligence. Unlike the listed stock, there's no information readily available where you could go and look. So a lot of work needs to be done. So to invest in alternatives needs a total mind shift, both from the asset consultant and from the board of trustees. Now you ask our journey and why did we decide to go into this asset class? The reason is very clear, and you know as much as the audience know that there's a lot of delisting that is taking place in the JSE. And therefore your choices to invest are getting much more smaller and smaller. Now, if you want to make an impact in the country, like South Africa, you need to look at alternatives. So that's why CRF ended in this asset class. Just to put CRF into proper context, we are a DC fund, 38 billion Rand of assets. As you said, we are market leaders when it comes to investment in alternatives. We invest in private equity approximately 5%, as you said. It's actually 5.2. It's just under 2 billion Rand that we invest in private equity. And all other asset classes are infrastructure, unlisted debt, and so forth. So it's a very diversified portfolio of alternatives that we invest in. And then the question you ask, what was our journey and where did we start? We started way back in 2013, 2014, when we adopted a responsible investing policy. And our first allocation to alternatives was in 2015. When we adopted our investment policy statement, we have a number of key objectives that we listed there. But I'm going to highlight 3 of them in the interest of time. 3 objectives which is relevant to the alternatives. The first objective was to provide long-term competitive risk-adjusted return. And the second objective was to ensure financial security for active members and pensioners. The third objective was to seek to mitigate ESG risk where possible for our members. So these are the three objectives that has driven us to invest in alternatives. Now, what was the outcome? I want to just give two outcomes as to demonstrate what was the impact of investing in alternatives. The first outcome is that, let me just say before I mention that, many people think that investing in alternatives lead to sacrificing returns. It is quite the contrary. CRF returns are consistently in the top quartile, and we're doing so at a very low risk. Our returns do not fluctuate from worst to best performer from year to year. Alternatives are not volatile, and they provide stable returns. And CRF has actually, in 2022, outperformed the benchmark by more than 5% due to its proactive risk management approach. So you could see that the outcome was quite good for the CRF investment. And the second part that I want to say, remember, we also wanted for our pensioners to have stable income. Our pensioner portfolio has been receiving, in addition to its normal CPI increase, which is always 100%, and a bonus that we give every year, which is also 100%. From 2019, in 2019, we gave our pensioners 900% bonus over and above their normal bonus that they get. And in 2021, we gave them 1,200% bonus over and above the bonus that they normally get. And that is because we got stable returns that alternatives are actually providing. So investing in alternatives for CRF has been a very successful journey that we did, and it has had a very good impact for CRF.
Thank you, Sosile. I think it's insightful. I think it's humbling to understand that it has been a journey. It has been a journey to get to where you are today. Now, I think that the challenging macro environment is certainly must be top of mind for most people. And Svenja, if you look at just, developed markets at the moment, PE players are just facing sharp increases in inflation and interest rates, which obviously means a higher cost of debt and less use of debt to leverage returns. Also facing a slower growth environment offshore. How have you seen this play out in offshore private equity?
Yeah, I mean, talking about market impacts on private equity portfolios, obviously a deep topic, and without a doubt, there is an indirect correlation between public market cycles and private company valuations, albeit with a time lag. I think this is a very important topic that since you have a very long-term investment horizon of private equity and venture, the capital which tends to span across different economic cycles, even in downturn phases, like we see at the moment, you can ride these downturns, meaning that you can realize the value of portfolio companies at times that will generate the best results. Right now, what we are seeing in our own portfolio, and we have almost 300 underlying portfolio companies indirectly through our underlying private equity fund managers, we don't really see a deep dip in valuations. So the contrast is the case that most of our funds are actually quite sustainable, and that the valuations are quite strong, and that our managers, despite the overall macro environment and political issues, can still realize or exit companies, so sell companies and give money back to investors. And what have we done to achieve that, or why can our GPs, our general partners, our fund managers actually deliver returns? One of the reasons is that we are always choosing specialist GPs, which are focusing on sectors with strong tailwinds. So when we do our portfolio construction, which is a lengthy phase with a lot of financial modeling and stress testing, we also consider potential macro impacts. I mean, when we started to invest our current portfolio in 2018, we could not foresee COVID, and we certainly couldn't foresee the Ukraine-Russia war. Maybe inflation was something that was expected sooner or later, but not to this extent. But still, we always look for GPs who have been through downturn cycles in the past and who come with a lot of experience. Another very important aspect in choosing the right GPs and the right business models or investment strategies is also that you're looking for operational value creation skills. So many of our GPs have quite large teams of operational or functional experts they are sending into their portfolio companies right at the beginning, but also when things are not going according to plan. So these operational experts are with the companies for long periods of times and helping them through their skill set, through their breadth of experience. Yeah, even in, especially in private equity, downturn cycles and macroeconomic challenges can actually play also in the favor of a GP, of a good GP. And you can construct the portfolio in a way that you can mitigate these risks. I think I should stress one point, and so Yesili has actually touched upon that. It's very important to stay disciplined, to find the right managers. These are lengthy processes. Our team has done it for a long period of time. We are looking at more than 1,000 funds every year, and we are also selecting 3 to 5 funds for the portfolio. So it's a very disciplined, lengthy approach to this, since there is a very high dispersion in returns between the best manager, the top quartile manager, and the lowest managers, or bottom quartile managers.
Thank you very much, Svenja. I mean, I think that just talks to resilience, the resilience of this asset class, you know, given the long-term investment horizon and the various cycles that it can ride out. Lebo, just bringing this back to South Africa, we're obviously seeing an increase in inflation and interest rates. What, in your view, still makes this an attractive asset class to invest in right now?
Thanks, Ria. And I think it's also important to look at data. We're fortunate that, in fact, you know, the SAFCA 2022 survey is out, and, you know, some interesting data that's come out from there in this regard, because I think generally, obviously, during tougher times like this, there is a worry that, you know, to protect margin, things like, you know, laying off a staff would be a high priority for private equity players and their underlying portfolio companies. And actually, what's been interesting to see in the data that from the survey that, you know, these private equity firms, so the general partners themselves and portfolio companies, through those engagements, that they've prioritized other cost-cutting efforts, you know, renegotiating with vendors, you know, cutting down variable costs like entertainment entertainment and the likes. And so I think it's encouraging to see that, you know, there's a kind of rethink around how you deal with kind of cost pressures. But coming back to, you know, these macroeconomic impacts, and I guess we're fortunate also to have, you know, our own, you know, call it head of asset allocation and chief economist. And so we formulate these views and see how that will ultimately impact on our underlying investments. But I think it's important to state that, you know, the impact of inflation, you know, or the changes of inflation locally versus what you see globally has been much more muted. Because I think you can, you know, sort of look at things like the fact that, you know, the unfortunate events that are happening in Russia and Ukraine haven't directly impacted us because they're not strong trade partners to us. And so from an investments perspective, but clearly it had an impact on energy prices and food prices, but it's definitely been much more muted in the South African context. We forecast that, in fact, that we'll see that, you know, inflation will increase more mutedly, you know, and we see it peaking sort of on our perspective in 2023. And so an interesting viewpoint in this regard from an interest rates perspective, again, you know, we've seen in global markets, especially in the US, that, you know, rates have more than doubled, you know, whilst in the SA context, it hasn't happened in that same vein. And so we will continue to see definitely, albeit mild, increases in interest rates. But from our own forecasts, we also see that, yes, you know, sort of the prime and repo rate will go up, but we see plateauing sort of the back end of 2023 and 2024. It will have a negative impact on obviously debt and the likes, but when I look through some of our investments from a private equity perspective, many of these managers, in fact, don't use debt. And so it doesn't have a negative impact we perceive from that perspective. Growth obviously is an important one. Again, I mean, I touched on this point earlier that, in fact, our perception of where growth is that it's actually better than pre-COVID levels. And so I think, yes, there are concerns. I mean, look at what's happened to the Rand. I mean, the Rand today is currently at, you know, sort of 18 Rands to the dollar. Our own internal kind of fair value assessment is between 15 and 17 Rands. And so we think that the Rand actually is on the cheaper side, you know, and that has had direct bearing on the valuations of local companies. And so, again, I think an important marker to note that if you are thinking about timing your investments into private equity, this is probably be a better time. But I want to go back to this point. And I think, you know, the concept of rank cost averaging is very important here, that, you know, timing markets is a very difficult thing. And so it's important that, you know, through the life cycle of this asset class, that you continuously reinvest into it, because, you know, market economic conditions change all the time. There'll be a good time to invest in private equity. There'll be a bad time to invest in private equity. But when we look at the numbers through the long term, that the clients benefit in staying invested. And that would be always, you know, the ultimate point that we put out with our clients.
Thank you so much. Thank you so much for that level. I think let's just switch gears and talk about some of the misconceptions, maybe you could say, or just concerns that I've certainly heard raised from pension fund managers when it comes to getting their head around this asset class. And liquidity is a key thing that often gets raised. And so you see, with 20% of your portfolio in alts, how do you practically manage liquidity?
Thanks, Ria. Well, when it comes to CRF, we view managing liquidity as an ongoing management strategy. It's something you do on a daily basis. Firstly, just to understand that CRF's monthly contributions that we receive is more than 310 million Rand. So that alone gives us the flexibility to deal and manage our liquidity issues easily. Our investment horizon is always long-term, especially as many of our members are retiring within the fund. So retiring within the fund means that you've got a better way of dealing with your liquidity problems. The other thing we do is to follow exactly the directions as given in Regulation 28. We analyze the profile of our members, and with the assistance of our asset consultant, we determine our liquidity requirements in the short term, medium term, and long term. And that allows us to manage our liquidity in a much better way. Our investment strategy as well is well diversified, and we invest in asset classes that can provide liquidity at a short notice. So, as I said earlier on, it is an ongoing management strategy on a daily basis. Some of our private equity exposure is self-liquidating, like the mezzanine debt and so forth. So CRF currently is working on innovative ways to have smaller retirement funds with the challenge of liquidity. And that is an ongoing plan that we're working on. Soon we will be launching that, and the cat will be out of the bag. Thank you.
Great, that sounds interesting, Soisile. Just complexity and risk. This is another thing that gets raised, that the asset class is more complex than others, and some struggle with the perceived lack of transparency. Now, Lebo, this question is for you. How have you gotten comfortable with what's under the hood, so to say? You're on mute, Lebo.
Sorry, apologies. So thanks, Ria. And so I think over and above this kind of complexity and perceived risk, I think our own exercise, by the way, when you do diligence a general partner, is about trying to figure out whether they can outperform going forward or not. It's a forward-looking exercise. Obviously you use qualitative and quantitative analysis to be able to create this, and it's actually a very difficult exercise. But indeed, I think the transparency has improved over time. Where there's a broad sharing of information, to a very sensitive level through these data rooms that are provided. But I think it's important to also consider the fact that, completed DDQ, whilst important, isn't the only way. I think it's important to kick the tires, if you will. And so typically our due diligence process, on the listed side can be anywhere between 2 to 4 hours. On the private equity side is 2 to 4 days, because we actually spend the time with the underlying key principals to, in fact, even interview them. I'm not too sure how many other players do this, but we'll interview from the most junior member of that team to the most senior, just to better understand that there's alignment of thinking. The way that they express what the real value add is, is there, that there's a clear permeation of exactly what each strategy is trying to do. And so you spend a lot of time spending time with underlying portfolio companies. I think you can glean some information in this regard. All of this, speaks to a kind of very labor intensive process, but I think it does require a time there. I haven't even spoken about the legal component of making sure that you spend time better understanding the legal components to this. But in fact, I do believe that the industry has become better at this, that, looking at broadly even how we've also reinvested in our teams internally to make sure we create capacity to be able to do this work. But definitely it does remain a complex environment.
Thanks for that, Lebo. And I think it's important just to add that we, as managers of capital, also do extensive due diligence before we invest in portfolio companies, which actually just adds an extra layer of risk mitigation for investors. Now, fees have been raised as well. Svenja, just coming back to you, the asset class has been perceived as being more expensive. When compared to
Liebe was just saying we got better, or the industry got better in some things. What they haven't got better in is bringing fees down. So the typical 2% management fee, 20% carried interest in a traditional private equity fund that's widely acknowledged across the industry. So it's not a phenomenon that you see just in South Africa. Overseas in the US and Europe, in the large private equity market, it's still the 2 and 20 fee model. Where it has come down, or where there are more how can I put that, novel structures on the fund of funds level. We also implemented a structure or fee model that is more aligned with investors, that only a management fee gets paid when liquidity distributions are coming back. But undoubtedly, the fees within private equity are significantly higher than for other standard publicly traded asset classes. But this is for a reason, actually. I mean, you know it as a private equity manager, Ria, deals must be sourced, they must be negotiated, they must be managed, they must be exited, which is all a lot of work. It demands a lot of resources. It's a long-term process because you tend to hold assets for a couple of years. And so the management issue is much deeper and much more profound. It demands a lot more resources on the operational side. I would like to stress one point. The mere existence of higher fees should not be a reason for pension funds to avoid private equity investments, because if an investment vehicle can provide superior risk-adjusted returns net of investment costs, the absolute level of these costs should not deter somebody from choosing such vehicles.
Thank you, Svenja. Thank you for that. I think I'd like to just take the discussion to impact. So Celia, I know this is a topic very close to your heart, but you know, we've obviously seen impact themes taken the center stage globally. And just bringing it back to South Africa, our specific economic and social challenges that we face in this country, how do you think the private equity asset class can contribute to solving for some of these challenges, and how has it done so in your portfolio?
Thank you, Ria. If you look at CRF's responsible investment journey, we have presented it to a number of platforms, the FSCA, the CFA Society, the Actuarial Society of South Africa, BATSITA and SAFCA. The approach we're doing is very clear. Our responsible investment strategy targets 3 specific sustainable goals. That is affordable and clean energy, good jobs, which is a SDG 8, and SDG 13, climate action. Those are the 3 goals we're doing. So our target is job creation and just transition. That's the key initiatives that we are looking at. More than 2.9% of our asset is invested in renewable energy, while more than 2.5% is invested in funds that explicitly target job creation, but also seek commercial return. So CRF is very much involved in looking at the impact that this could do to our members, to mitigate the ESG risks to our members and so forth. CRF has created more than 18,000 jobs since 2015. And this is a third of the coal industry in South Africa. 18,000 jobs, more than 18,000 jobs that we have created. Investing for positive impact has not even reduced the returns, as we say. We are saying we don't want our members to retire in a wasteland. We want our members to have good returns, but at the same time, there must be good social impacts that result out of our investments. And this is what CRF has achieved, and we continue to work towards that as well. Thank you.
Thanks. That job stat is incredibly impressive, 18,000 jobs. I'm sure you're very proud of that. And I do want to echo your sentiments around job creation. I mean, I think the narrative from the offshore private equity can be about job cuts, very much so. But we must differentiate the South African story. The South African private equity industry is a growth industry. At Old Mutual Private Equity specifically, we focus on growing companies, thereby growing jobs. We also transform those companies from a gender and race perspective. I think we might have some time. That kind of brings our main discussion to a close, Anne-Marie. I think if we have some, do we have some time for questions?
Yes, Ria, I think we must just take one or two questions. And then the first question is, what are some of the key metrics to look at when doing due diligence on a non-listed opportunity?
That sounds like a question for Lebo.
Thanks very much for the question, Akona. And so I think from the perspective that we're a fund selector, so for us, an opportunity would be another GP. And I think it's important that one of the key factors is around idea generation. You know, how do these organizations, you know, come up with their strategy in terms of what is important to them. And so philosophically, it's important to understand what area of the market they want to play in, you know, what size deals they want to play in, what is their ultimate areas of success in terms of where the impact is an important component of it. And so I would say idea generation is by far the most important component. The second one, which I think the industry is definitely developing, is portfolio construction. I think what you want to minimize is having a completion of managers or GPs that in fact are doing very similar things, or the one GP is only invested in one form of business or company. And so I think, you know, making sure that there's a broad spread of different opportunities, whether it's in manufacturing, whether it's in other industries. And so we spend a lot of time trying to figure out what is the ultimate plan. And so for us, those are the two key components. Another softer one, but incredibly important one, is alignment of interest. And so we spend a lot of time trying to better understand, call it the diversity of the carry and how teams are incentivized, you know, diversity of thought, diversity of thinking from that perspective, because I think we can all agree that with all the challenges that we see in the markets, that, you know, backing a more diverse team is far more important than one that is less diverse from, you know, many areas. And so I hope those three elements you think are important, but those are the things that we typically look at.
Thank you.
Thank you. Great. I just want to maybe hear some comments about the pipeline that we have available in South Africa. You know, how deep is it? How available is it? And, you know, I mean, when I listen to the CR fund, to Soyesile, they're keeping it simple, very focused in terms of what to achieve. And, you know, you add it, but talk to me a little bit about pipeline and, you know, whether that is an obstacle or whether there is sufficient projects in South Africa to invest in. I don't know, Ria, whether you want to give it a go.
Yeah, I can share some insights there. I mean, I think that we are very blessed in this country to have some world-class entrepreneurs. And if you look at the listed market, we've got about 300 listed companies, but in the unlisted space, there are thousands of companies that are run by very smart entrepreneurs in this country that are thirsty for capital. And the private equity model is really what it is a conduit for capital into those unlisted companies to back those entrepreneurs. And that is really the engine of economic growth. And some would say innovation in this country as well. So Isile touched on it earlier, but just the actual landscape of opportunities is, we think, very deep in South Africa.
Great. I wonder if we still have anybody that wants to ask a question or a comment. We unfortunately have to go, but I must say, Ria and panel members, you know, I was thinking, when will this conversation come? What about liquidity? What about cost? What about risk? What about, you know? And I must say, you have answered, well, all the questions that I could have had today around this. And I just want to congratulate CR Fund once again for your initiative and, you know, for sharing your knowledge, because it is true. It feels like very complicated, but you make it sound very easy to get there. And actually, it's maybe not as easy and not as difficult. And then there's some comments here. Well done on the CRF on your journey, and thanks to the panelists for insights. So thank you very much. I hope this is not the end of the conversation, Ria and colleagues. There is much more to talk about. And Svenja, thank you so much for, you know, also sharing the perspective from the international platform. Thank you so much, and I hope that you have a lovely day, and we hope to see you soon for year end.
Thank you, Anna Marie, as well. Thank you very much as well to Betsesa and the panelists. We just got a video to play.
Thank you.
We've got one video to play as we sort of round.
Oh, you have a video to play? You're very welcome to do that, and then we will close.
Thank you. Yes.
Thanks, everybody.
My name is Ashton Lawrence, born and bred in Cape Town at the end of, call it 2010/2011. So I was retrenched. Those were very challenging times.
Can you
so
see
I
the
was
video?
actually living.
Can we maybe just replay it? Mpendulu, are you running the video? There you go.
My name is Ashton Lawrence, born and bred in Cape Town at the end of, call it 2010/2011. So I was retrenched. Those were very challenging times. So I was actually living in a Wendy house. We had 2 kids and we had 1 room, and everything was like a mess all the time. I started in food care at Access Park the year 2012. I never had a matric. Food care didn't turn me away. They had a look at my CV and they were willing to offer me a salesman's job. And I took it with both hands, I grabbed it. You can also grab 2 Viva Italian inspired pairs and pay only 700. That's off the runways of Milan. We made the plan, customers. It's hot fashion at my Kim Kardashian.
Old Mutual Private Equity is one of the largest and most established private equity managers in South Africa and in Africa. We've been investing other people's money for 20 odd years. We've deployed in the order of 10 billion over that time period. I think the power of the private equity model lies in the active ownership. We talk to our management teams and our fellow shareholders every week. And it really is about getting up every day and driving value in the portfolio and making the businesses that we own more valuable. It's long-term value focused. A nice illustration of how partnerships actually work in private equity is Footgear.
Back then, shoes were not as they are now on display in bulk. There was one shoe on show and people couldn't help themselves. You had to have someone to help you. So that was kind of the gap that we identified, to bring the shoes out and let customers help themselves and get the feeling of volume. So the first Footgear store opened in 2001 in Access Park. From 2001 to 2009, we were a 4-store business for all intents and purposes. And then we had a strategy session with the 4 then owners, and we decided to go on an expansion run. 2018, we went up to 63 stores. What was happening simultaneously was the opportunity to acquire Edgar's Active. I remember quite clearly getting an email out the blue from Chimani Kula at Old Mutual wanting to have a cup of coffee. And you know, from the first meeting with Chimani till we consummated the relationship 3 years later, he would just constantly stay in touch. And I think through that process, we clearly established that they were by far the partners of choice for us. So we had 63 stores when we did the deal. We then acquired the Edgar's Active stores. We managed to acquire 110 of those stores. There were about 750 people that came across with that transaction that otherwise would have been unemployed and retrenched. The end of financial year 2023, the result is that the business will be around 250 stores with probably about 1,200 permanent employees. The rule of thumb is for every person employed, there's 5 people that rely on that individual. So I think it has a big impact on a lot of people's lives, and hopefully it's a good impact, positive. Working with Old Mutual Private Equity, obviously it's a financial investment, but it's much more than that. In 2020, the COVID phenomenon certainly tested our business on lots of levels. When you come out of lockdown from doing 0 sales, are we going to go back to 100? Are we going to do 50% of sales? How do we engage with staff? COVID protocols. The Old Mutual partnership played a huge role in us getting through that process. We just viewed them as a colleague to give a call and brainstorm. Felt like they were on the front line with us at any given time. There was no them or us.
Today, I manage 13 stores from Vredenburg all the way to Mitchell's Plain. You know, I'm responsible for about 60 people. So I take it upon my own shoulders, you know. They're not that broad, but I take it upon my shoulders to make sure I do my job the best I can so that we can open stores and employ more people. The better we do, the more successful we are, the better it is for our country.
It's actually about growing the business, and in growing the business, we grow a lot of jobs. It also gives us, together with our entrepreneurs, a lot of meaning. Impact to the community, bursaries, academies, the many things that we support. For us, it's just part of stewardship.
Due to Foodcare, I will basically be getting a accredited certificate, equivalent to a matric certificate, the NQ4. 5 months ago, I moved into my own place just down the road, and that for me has been the best thing. The wife was just so happy. When she heard I could make it possible for us to move, she was over the moon. So I'm so happy for that. It can bring tears to your eyes sometimes, you know. Thank you, Foodcare.
Thank you, everyone. Goodbye.
Thank you so much, Ria, and have a good day, colleagues.
Thank you very much. Bye-bye.
Thank you.
you.
Thank you very much.
Thank you
Goodbye,
very
everyone.
much, everyone.
Bye.
And greetings
Bye-bye.
from Germany. Bye.
Thanks, Svenja.